All right, today's micro class is going to be an introduction to moving averages, and it's not going to be a breakdown of how they're calculated, but even more specifically, how the market uses them and interprets them as far as they relate to price action. So, what does the interaction of price with these moving averages typically mean? How does the market interpret them? I'm going to break it down for you guys. We're going to look at exponential moving averages, 3 of them, and we're going to look at simple moving averages, 3 of them. So to start things off, we're going to talk about the exponential moving average, and we're going to look at the 5, 10, and the 20. And if you understand these basics about these moving averages, you could put together a strong foundation of how to hold your winners longer and how to let go of your losers sooner. And this is one of the number one mistakes that beginning traders and retail traders make, is not knowing when to get in and get out of a play, to not know when something is not a good deal and it's not on sale, it's completely falling apart and Wall Street's abandoned it, but you're still somehow holding on. If you simply understand these 6 moving averages, and if you respect that knowledge and you apply it to your investment and speculation decisions, I truly believe that you'll be a more profitable trader. So let's start off with the 5, 10, and 20. And here's what I want you to understand about them. When price is above the 5 EMA, it has strong momentum. And what is momentum? It's not just a stock that's going up, but it's a stock where the price moving up is accelerating. And so when you have a really good pick, right, a hot stock, it will bounce on top of the 5 EMA for days and days and days. Now, here's what you want to take away right at the beginning. If it only bounces on the 5 EMA 1 day or two days and it drops beneath, you haven't picked a good stock. And you say, well, how would you know that? Are there stocks that repeatedly bounce on the 5 EMA, Josh? Absolutely. We're going to look at NVIDIA, and you're going to see that it spent months bouncing along the top of its 5 EMA. Now, the way that you use the 5 and the 10 in particular, the 10 confirms the short-term trend. You'll find that the price bounces along the 5, but it does begin to lose a little bit of strength. And if it comes back and bounces 1 day on the 10 and the next day back above the 5, it means the trend is 100% intact. Now, if you follow the pattern on a strong stock, you can have red days and green days, but as long as they're above the 5 and they remain above the 10, you need to know the trend is still clearly defined up. And so if you simply hold on as long as it's above the 5 and the 10, you're going to be making a decision to stick with the overall trend. Now, how does the 20 come into play? Well, the 20 is the strongest support level for the bullish move. And so after you get a couple tests of the 10, at least 2 of them, you'll eventually find that it has to have a bigger pullback. And if it does have a strong reaction and bounces on the 20, it'll the following day go all the way back above the 5 and the trend will be intact. And so if you simply use these 3 exponential moving averages in connection with each other, these are the ones that are the offensive move of an up moving stock. There was a report that was done that showed that the biggest stock market winners usually found their support on the 20 EMA. If you simply bought a stock once it moved above the 20 EMA and eventually sold it once it confirmed beneath, that on average, you would have at least a 30% return. Now, I know that there are some folks out there who simply have not found a consistent way to make money on Wall Street. And I'm not telling you that you can use moving averages alone, but you can use moving averages as a basis for deciding whether you should be in or out of a play. And that brings us to the next 3 moving averages. And this will tell a lot of you everything you need to know about your portfolio. Because if you go and you turn on these moving averages on the chart and you look at the price action and everything that you own is below these 3 moving averages, it means that you don't have your portfolio set up correctly and it's not positioned for relative strength. So we're going to be looking at the 50, the 100, and the 200. And this is going to be your defensive sector. If price is interacting with the 50, the 100, and 200, then the current up move is no longer valid. specifically, if you're below the 50, the up move is over. Now, the 50, bouncing off the 50 is somewhat considered the final stage of a bull move defense. And so if you stay above the 50, if you get a beautiful, tall tailed wick that just comes down and hits the 50 and goes back up, then you're okay. That's actually considered a defensive line for the bull move. Now, again, if you want to trade best in class, then you just stick with stocks that are above the 20 EMA. But if you want to watch for stocks and get really good entry, you might consider if they pull back and bounce on the 50 with a lot of strength, they might be good potential winners. But the minute they're touching the 50 or the 100 or 200, understand that these are not best performing stocks on Wall Street. So 50 can be viewed as an uptrend defensive line. 100 and 200 cannot. A 100 SMA, if price comes down to the 100 SMA, it's had a huge price drop and something is seriously wrong, and price is being controlled 100% by the bears. Now, here's where the 200 SMA comes into play. At some point, we end up in a correction, possibly even a crash. And at that point, we're dealing with some pretty negative news. And negative news sometimes takes some time to unwind. The market knows you're not just going to go from bad earnings to good earnings overnight. And so it's going to be a time period in which the price moves down beneath the 50, beneath the 100, beneath the 200, lingers typically beneath the 200 for a while. Then when we begin to get better data, the majority of stocks begin to move back above their 200-day moving average. Now, when the majority of stocks are beneath their 200-day moving average, you're definitely in a correcting recession market. But eventually, when the majority, specifically the Magnificent Seven, get above their 200-day moving average, that's an early sign that it's a good time and a confirmed moment, perhaps, to begin to invest long term as it's moving back above the 200. Now, you've got time, okay? Because remember, if you're dealing with the 50, the 100, and 200, the market's not hot. It's entirely cooled off. And the price is going to interact between that 200, back up to the 100, possibly test the 200 again. But if you're a long-term investor at that point beneath the 200-day moving average, then you will get a better return. If you try to DCA from 20 EMA down to the 200 EMA, you're going to lose a ton of money. That's why a lot of investors who are seeking to protect capital simply don't buy anything beneath the 20 EMA. Now I'm going to give you guys one more SMA, and that's the 250 SMA. And there are bargain hunters who wait for good companies that get wrecked to come down to the 250 zone, and that's where they choose to buy and take some risk. I don't think retail traders should focus on that. I think retail traders should try to find the hottest stocks and stick with them and buy them if they're above the 20, 10, and 5. But let's take a minute and check out a hot stock that you're all familiar with, an NVIDIA, and we'll see if it proves the case about how to trade these and how to hold on to your winners. All right, we're going to keep this portion very simple, but you guys can see that when price broke above all three of these EMAs, we went on a real strong up move that lasted a long time. And here's one of the main things I want to point out to you. Sometimes people get scared, and the very first red candle or the very first pullback they get, they sell and take profit. Guys, I want you to look at that 5 EMA. If you're in a hot stock and it's been hot for a while, even if you get a red day, you want to hold it, because as long as it continues to open and close candles above the 5 EMA, the move is not over. So NVIDIA ran for 30 days above the 5 EMA before it came back and tested the 10. And you can see that as soon as it did, the next day it opened up above and pushed above the 5 and ran another 15 days. Now, after having done that, you saw that it attempted to test the 10 again. We got a couple red days, and that led to the test of the 20. But you got to remember, the strategy is to hold your winners if they're above the 5, 10, and 20, okay? As soon as it hit the 20, and the 20 is the bull support level, it rocketed up the very next day back above the 5. And so again, it ran above the 5. Only then, when it began to test the 10 more often, did you get the opportunity to potentially take profit and sell, because we were now moving into a different phase. When you're in a hot move up, you're not going to get a test of the 10 every day or every other day. But when you begin to get a test of the 10 every other day, then it means that the trend is coming to an end and you may consider taking profit. You definitely want to wait for it to have bounced off the 20 at least once in that time frame, because that will enable you to realize the majority of the move. All right, let's bring on the SMAs to see how they played a role in NVIDIA. Okay, so on a hot stock, the price is far away from the 50, the 100, and the 200. And the most important point that I wanted to make here is that when NVIDIA eventually cooled off after it hit $1,000, we got a double top up here. When we eventually broke beneath the 10 and the 20, the blue line is the 50. And remember, the blue line is the last defense of a bull move. Now, the price did break beneath. Even if you had sold at the 20, you could have chosen to get back in when the price came back above the 20, and you would have again participated in a huge move up as it continued to bounce on the 5 and the 10. So, you know, we marry the moving averages with a couple other views. You guys see these bearish ascending channels that I talk about, together with the fact that price moved back to the 50. This was a pretty good indication to get out and not to hold NVIDIA. You know, there might have been a lot of buyers at the 100. That would have given them a back test of the 50. But when we got rejected at the 50 again and didn't break above, it was another opportunity to go short. And once we got back above the 100, we are now officially back above the 50. And that's one of the reasons why I said regarding NVIDIA today that if we could close the day above 120 and tomorrow we can open and close a candle above 120, then this is actually an entry point for the bulls, which means that we can absolutely get all the way back up to 130. So this is just an introduction to moving averages, and I'm going to do intermediate and advanced because how the moving averages interact with each other, and there are other moving averages that are commonly used in day trading. We're going to cover those individually, but I wanted you just to have a big picture view. If you're a retail trader, I want you to look at your portfolio right now, and if everything you own is beneath the 50-day simple moving average, your portfolio isn't right. You've got to be in some stocks that are winning. And I talk about some stocks on my show. Today, I talked about Meta is a stock that's outperforming. And the very day that price moved back above the 20 EMA, that's what people should have been in. All right, guys, I'm going to leave it there. Let me know if you've got any questions on these moving averages, or if there's one moving average in particular that you'd love for me to cover. I will get around to doing more of these videos on moving averages. I think it's going to be very interesting. And if you guys incorporate this knowledge into your investing, it absolutely will help you make more profits. Thanks to you guys for tuning in. Appreciate all of you. Peace and blessings. Take care.